I met my partner Claudio the first time we met, actually at one of our masterminds that we attended as well. And so we got together afterwards, right, and got together for lunch and so forth. It was kind of like a first date where we're talking like, oh, what do you like to do? What I like to do? Oh, okay, gotcha. What are your strengths and weaknesses? What mine? So we kind of had this conversation. We realized, hey, we've got a really good compatible relationship here. He brings a whole bunch of business strategy, owns companies, that sort of thing to it. I bring obviously energy and relationships and, drive and all that kind of stuff to the table. So we formed the together, and we started raising on a deal actually, like right back in June of 23. So over a year ago, we started raising for a deal, and we jumped on that team. We got into the deal, closed the deal. And through that, we also met our two other partners, Jim and Ritesh, right? So they were also, raising separately for that same deal. So afterwards, we came together and said, guys, like, 4 is better than 2, right? And 2 is better than 1, right? So why don't we go ahead and form, the 4 of us go together as partners in this thing and see where it takes us, right? And that was the start of a beautiful relationship.
So you have to remember, folks, that, real estate is a long-term investment. It traditionally outperforms anything publicly traded, especially, and by the way, REITs are not the same. Don't go buy a REIT. That's anything publicly traded is subject to emotional sales, right? But when you get into a project that's, at least 5 years, just don't count on money coming back in 2 or 3 years. Focus on the 5 year, 10 years better, right? Because it's really a 10-year game. But if you think about it, there's going to be a cycle, and they're about every 10 years, honestly, right? So you're going to have a cycle in real estate. And so the good thing is the cycle with everything tightening up, meaning all the money got more expensive. Investors are more on the sideline, which I'm going to come back to. So put a pin in that. There's more investors on the sideline right now because they're scared, right? You see tough press. But the funny thing is, this cycle, the fundamentals are really, really good still on the properties. The only thing wrong with the pricing on the properties is the money, the debt got too expensive because interest rates went up, right? And so, yes, naturally, if you have a physical asset and you're like, well, it's actually worth this, but the cash flow is saying it's worth this based on the debt, I'm not going to sell it unless I have to right now. So that's meant a lot less deals have been done.
You're listening to the Real Estate Runway podcast powered by Quattro Capital, where we're all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, Chad, the investment maverick.
All right. Real Estate Runway family, welcome to the last Real Estate Runway episode for a little while. We're going to miss you, but we're going to come back to you here in a couple of weeks with some really bulk curated content. So I'm super excited for that. Not excited to leave you for a little while, but here we go. Before we get into today's episode, if you get any value out of this or anything we do, folks, hit those little 3 dots on the top of whatever you're doing this on and share it with somebody. Just pay it forward, swipe it, like it, subscribe to it, leave us a review. Just do something to let the computer know you like it so it'll share it to more people. Pay it forward, all right? So now that we get into the show today, I'm going to welcome a friend of mine, Jeff Ervick with Velourus Capital Partners. We've been trying to do this episode forever, and yet again, it is my schedule that's been preventing it. So, Jeff, thanks for being patient. Welcome to the show, brother. How you doing?
Oh, I'm doing awesome, Chad. I appreciate you taking the brunt of that one. But no, I mean, I think it was a both reciprocal way, right? Our schedules are crazy and busy, but I'm glad we had some time here set aside to chat. So I'm looking forward to it.
Absolutely. So before we get going here, I always like to let the guest just tell us who you are, how you got into this business, what got you to today. I know you, the audience doesn't, and I'm going to be pretty terrible at reading your bio. So just give it to us, tell us where you've been and how you got here.
Yeah. No, I really appreciate that. Right. So, so Jeff Ervick, I've been in sales, specifically technology sales, IT sales, right, for almost, just over 20 years, right? So I have a very long track record in high net worth type sales, in technology with, I worked for a staffing firm. I worked for two companies out of college, Chad, just so you're aware. A lot of people our age, I'm not to say you're as old as I am, but because you look younger, but they usually work three years in a job and they move on, right? I've actually had the luxury of being able to work for only two companies, besides ones that I've started out of college, right? So first company I worked for about 12 years, and then a little over 12 years, and then I've been at my current company about a little over 10 years. So yeah, almost, I guess that makes it 22 years of in sales almost, right? But I started out in a what I would call kind of like a boiler room type of mentality, right? And that's really what is kind of where my, I guess, I don't know, my drive and all my my ability to be very resourceful and have thick skin, right? Because we were basically head to head with some other people, make a bunch of phone calls, who can be the loudest, who can talk the most, who can set the most meetings, right, and so forth. So I really learned a lot about that, and also about rejection. I mean, that's a big thing, right? So people don't talk about that, but being able to get rejected a lot, right, and then let that roll off and not let it like eat at you, kind of is another thing that I think I learned big from there. But ultimately, in IT's technology sales, right? I did that still doing that. Actually, I have a day job, right? So I still do that as a W-2 employee. But I came to a point where I've always loved real estate, right? And in 2017, one of my buddies invited me to like a meetup, right? Like a real estate meetup, a local meetup with a bunch of realtors and investors and so forth. And I was kind of sitting there like no idea what to expect. And I got just blown away by the amount of knowledge in the room just locally, right? So I kept joining those meetups and so forth, building my network. And eventually I'm like, I'm going to buy a rental property. I'm going to go buy a rental property. That's what I need to do, right? I have some taxes I got to write off, and I've got I want the business aspect of it, right? What can I do, right? So I went to this, you've seen like the TV shows where people stand in front of, the house, and there's a bunch of people putting up signs, that kind of stuff, like, live auction, basically, right?
Yeah.
So I did that. I went out to a live auction. It was freezing cold, middle of the winter, up in this place outside of Baltimore, Maryland, in a place called Dundalk, Maryland, and row homes, and I was bidding on it, and I was looking at this other guys bidding on it. I kept going back and forth, and finally locked up my first deal. Nervous as hell, right? I was so nervous, right? I bought this property for $69,845, right? I still remember the number. And then I'm like, all right, what's next, right? And there was a waiting period for it. It was a foreclosure. So eventually I got the property, took ownership of it, brought in a buddy of mine to help me run the project for the project management aspect. And we flipped it. We did the BRRRR model, right? Buy, rent, buy, rehab, rent, refinance, repeat, right? So we did that. And I literally walked out with like no money in the deal, right? It was amazing. I borrowed money, private lending from it. Who paid for the property and all the other stuff, and went through. So anyway, long story short, I acquired a bunch of different rental properties, did a bunch of flips, and I do private lending as well myself. And I got to a point where I'm like, you know what? I don't know if this is scalable in the single family market. I've got a handful of rental properties. They're cash flowing, they're great, but that water heater just cost me 3 months of rent, right? So 3 months of profit. So I started looking into it and got deeper and deeper into what could be my next avenue. Looked at short-term rentals, which I actually do have one of those, and looked at some other options, but really kind of honed in on multifamily, right? And so that's actually how you and I kind of met, right? We met at a conference, not multifamily, but a fund launch conference, right? And
right.
And
where was that? Was that Miami? I can't remember where we were. It was somewhere nice.
Yeah, it was in Miami. Yeah, we and we'll get into that story as well too. But I end up looking into multifamily, and I said, you know what, that's the way I want to go, right? So went full steam into it. Met a bunch of partners. We I'll get into our history as well too. But we've acquired $150 million of assets under management in the last 18 months, right? So it's been a crazy ride, and we're not stopping by any means necessary. So that's kind of a little bit about me. I know I'm sure I've just gave you a bunch of nuggets and tidbits and that kind of stuff, but yeah.
Yeah, no, it's good stuff to get into. And I love the walk there. So you experience, as most of us do, like, hey, Wow, I really realized I don't want to be trading my time for money forever, right? I realized that I only have 168 hours in a week, and I want to, figure out how can I start buying little machines, little black boxes that create cash flow. And so you figured out, well, gee, I know that within my realm, I can afford to, probably come up with 69 grand and maybe a little bit more, or borrow that money and go rehab a single family house. And you did that 2 or 3 times. Like, well, damn, I've really only got like what, $1,000 a month coming out of that. And then I just had a
Yeah.
water heater and there went 3 grand, So
Yeah.
it's like, it is also a good way to grow, but you start thinking about, well, what's scalable, right? And in any sort of transaction, you always have two things. You have people who have time and not money, and you have people who have money and not time. And what sparks static electricity between those two people is the creation of value, right? Because those who have money but not time are looking for value creators to create return on that money. And
Yep.
those who have time but not money are figuring out, how do I bring value to those with money so that I can make money, is some of that created money, right? And so that's exactly what you kind of shifted to, is like, well, my means are so far, but I need to figure out how to pull a bunch of people together and buy something, some big black box, and then out of the proceeds of what you create, you get a cut of that because you brought the value, and the people who brought the money are happy as can be because they've gotten, value created by somebody else. So that's kind of the walk that I think a lot of us are figuring out. And I love, like folks listening to this show, I love that you are getting to experience that through a number of different people. So before I hone in on what specifically, you're bringing to the table and the partnership is your value, you mentioned the fund conference a little bit. So why were you at a fund conference, where you ran into me as you were having, like, what was your thought process at the time of what took you there?
Yeah, so I end up going through a mastermind program, multifamily mastermind program, like the week before. But prior to that, I was the social media probably gets you right. But I was looking at certain things. I'm like, oh, what's this fund thing? Let me look at that. Right? Oh, I can start a fund and I can grow it and buy a bunch of real estate with it. Right? That was kind of like my thought process. And um, I was following a bunch of the people that were speaking at that event, and Ed Milet, I think he was one of the speakers there. In fact,
yeah.
I ran out afterwards and just shook his hand. I'm like, I got to shake your hand. You're awesome, and it was great. But there was a ton of value that was given at that conference. But the reason why I jumped in, like, I wasn't sure, and I was sure I was going to do it, but I ended up. Pace Morby was like announced as one of the speakers. And I'm like, all right, Pace knows his shit. I'm gonna go ahead and do it, right? So I jumped in, and that's why I went and went down to that conference, and it was like very random how you and I met, right? My buddy Sean and I, so Sean runs a hard money lending business up here in Baltimore.
I remember Sean, yeah.
Yep, and I'm one of Sean's investors, but we're also buddies. He's actually the guy that I was talking about that brought me to that first real estate meetup, right? So that's kind of how we kind of full circle there, right? And now Sean's like my neighbor, lives like 5 houses down too, so it's pretty cool. We get to hang out a lot. But anyway, so I said, Sean, like, you're in real estate, I'm in real estate. Like, I want to be in real estate more. Like, let's go meet. Let's go down to this, and see what it's all about, right? Figure it out, right? And we left the first day like just excited as all heck, and we sat down for dinner at this random little Cuban restaurant right outside the Miami Convention Center. And what happens is we're sitting there talking, and all of a sudden Aaron comes in and is like, "Hey guys, can I sit down here? Does this work?" I'm like, "Sure, go for it." Right. So she sat down. Maurice sat next to me. And then you and your mom, you and Tammy sat there, and I think Kim wasn't there, I don't believe, right? But
Kim was not there for that, no. And you, so what he's naming, folks, are the other Quattro partners, and those of you who know, Aaron is the most outgoing individual in the world, so this is naturally how this happens, right?
Yeah, exactly. Her and I, we sat there across, and all of a sudden we're just like we're going back and forth talking, have a good time. I mean, it was like her energy fed off me, and I was like, I gotta, whatever they're doing, like, I gotta be a part of it, right? So we all bond, like the four of us all bonded on that, right? And we were talking, and throughout the entire time we were like, let's just keep talking, let's keep in touch, and so forth. And we end up going through that. And one of the wildest things, Chad, is that I'm very like, I wanted to get into real estate and multifamily side, right? And I was talking to my wife, and she's like, Jeff, she's like, I know you want to go out and buy a bunch of multifamily and talk to all your friends and have them be investors with you and all that kind of stuff. She's like, but you got to go do it yourself first, right? And I was like, huh, that's excellent advice, Kim. Thank you. That's my wife's name is Kim. I'm like, excellent advice. Thank you. So I talked to you guys, and you had the an offering out there for the meal, and I'm like, you know what? I'm going to invest with these guys. They know what they're doing, and they're very reputable, and we know people in the industry and that kind of stuff. So we end up making our passive investment with you guys, and here we are now. I'm on your podcast talking about real estate, right? So it's awesome.
Hey friends, do you ever wonder what goes into producing a podcast? Here's the thing. While anyone can create a podcast, navigating the booking and publishing process can be quite arduous. For years now, we here at the Real Estate Runway have been working with podpulse.live, and they are the real deal, let me tell you. Podpulse.live allows us to focus on our content. We record our story and let Podpulse handle the rest. From automated booking on the front end to a full-service production shop on the back end, Podpulse.live allows us to focus on what matters in content creation while they handle the rest of the machine at a very affordable price. Head over to podpulse.live or see the link in the description below to book a call. Let's get your voice out there. Yeah, absolutely. And you know what, I think what Jeff and I took away from that, folks, is there's, now that we're talking about group investments and pooling money together to buy a big thing collectively for individual shares, and getting that catapulting effect on the capital. There's kind of two ways to do it, right? One is, we all come together around this one thing. If you can see my fist here, right, on the video, and we all buy that one thing, and that's called a syndication, right? When you start talking about the concept of a fund, which now, we actually went and started a fund after, we were in the market to do that. So that's why we were down there. You say, okay, well, I want to be in this thing, but also for like it. And I want to make one investment, right? And so it's a little bit of diversification where you come into the fund, and the fund is chartered to go do that one thing 4 or 5 times, right? So that's the difference. And so just, as a little simple education for everyone listening, you can come into a syndication or a fund. They're really the same thing. Just a syndication is a single asset fund, and a quote fund is a multi-asset fund. So love it.
That's right.
All right, Jeff. So let's bring it back to you and Velourus Capital Partners. Tell me, every team comes together with, it's a bunch of value creators, right? So we've already established that you're a value creator. And for those of us out here thinking about that money with no time, or time with no money, I'm not going to say you have a lot of time, but you're a value creator. So what is it that you are bringing to the table, and what your company is bringing to the table, and what y'all are really doing for your investors out there today?
Yeah, sure. I mean, that's an excellent segment. So I really appreciate it. We came together, so to speak, right? Because there was a void in each other's lives, so to speak, right? Where we all kind of had the same mission. In fact, I met my partner Claudio the first time we met, actually at one of our masterminds that we attended as well. And so we got together afterwards, right? And got together for lunch and so forth. It was kind of like a first date where we're talking like, oh, what do you like to do? What I like to do? Oh, okay, gotcha. What are your strengths and weaknesses? What are mine? So we kind of had this conversation. We realized, hey, we've got a really good compatible relationship here. He brings a whole bunch of business strategy, owns companies, that sort of thing to it. I bring obviously energy and relationships and drive and all that kind of stuff to the table. So we formed the together, and we started raising on a deal actually, like right back in June of 23. So over a year ago, we started raising for a deal, and we jumped on that team. We got into the deal, closed the deal. And through that, we also met our 2 other partners, Jim and Ritesh, right? So they were also, raising separately for that same deal. So afterwards, we came together and said, guys, like, 4 is better than 2, right? And 2 is better than 1, right? So why don't we go ahead and form, the four of us go together as partners in this thing and see where it takes us, right? And that was the start of a beautiful relationship. So we all bring different value to each other and to the team, different pool of whether it's investor relations and different pool of investors we bring. So it branches our experience and our network out. Our strategy is to go in and find good value add, right, that we can provide to our investors, but also for the property itself. We've gone to our core, which is value add properties, right? And we've also branched off, and we are also doing some ground up development. We also just closed a warehouse, so we got some light industrial as well. So we've got, and I'll take that. The reason why I bring that up, right, is we almost have three different asset classes. And I know there is people out there like to say, like, hey, be a master of one before you can be a master of many, right? And I get it, right? And it makes your life busy and stressful and so forth. But me personally, my investment strategy is not to just invest in one singular asset, right? Or be one spot and do only one thing. Like, I'm not going to be investing in just the stock market, right? I'm not going to be investing in just real estate, right? And within real estate, Chad, there's a myriad of different things that you can invest in, right? Different assets, different classes, different locations, different size properties, all that sort of thing, different ways of debt structure, right? There's whole different ways that you can invest in. So me personally, I wanted to invest in 7 different ways that I can make cash flow passively for me and my family while I'm building a machine to go out and continue to buy, tens of millions of dollars of assets on an annual basis, right? Even more, almost hundreds of millions of dollars of assets on an annual basis, right? So I know maybe I answered your question in that, right? That whole that whole tirade there, and I speak a lot and I go off tangents, and so to reel me back in if you need to, right? But ultimately that's how we formed, and that's where we are headed, is to really hone in on 3 different asset classes, and then we're even stepping it up even further to go into Class A type stuff here soon as well.
Yeah, that makes a lot of sense. And so, just kind of talk about the experience lately, right? I mean, we all watch the news. We've all probably experienced some challenges in our investments. The last 2 years have been difficult given that the debt market has changed substantially. And it's all a result of post-pandemic stimulus money driving supply and demand on the dollar up, which caused inflation, and then we had to reel inflation in by pulling interest rates up. So we've talked about that a lot on the show. Everyone understands where we've been, but that naturally has an effect on your investment thesis, right? And so I think I heard you said multifamily value add. You've mentioned industrial. What was the third? I missed that one.
Ground up development.
Development of apartments or something.
Family, and single family, both actually.
Yeah, so residential, right? So you're kind of looking at 2 sides of the residential risk curve, and also industrial, which is fantastic depending where you are. So to kind of talk through some of the real world challenges that y'all have experienced. I mean, we've all experienced something. What are some things that haven't gone your way that you've had to mitigate as a team over the last 2 years?
Yeah, so you're right. I mean, sometimes looking at the properties, right? So like you're an expert underwriter. I know you do a lot of you guys value, or you underwrite a ton of properties on a weekly basis, and our team does the same thing. And I think one of the hardest things that we found is that the sellers are still not to a point where they are ready to let go of a property for the cap rates or the value that it should be, right? They still think that, and maybe that's also because they're stuck, right? They're stuck in a position where
that's a huge part
they bought it. Yeah. Yeah, they bought it with very low cap rates, right, and low debt that's fluctuated up, or that they're maybe not meeting the numbers or something like that. So there's still a like a seller and buyer disconnect at this point, right? But we've also found some good properties in there. You gotta you look at many, you find the few, right, that actually work. Where we've been able to structure in a couple of different deals. Some seller finance debt.
Yep.
We've been able to structure some institutional level debt on a property. We've been able to structure some bridge debt, right? so it's the equity piece is always going to be a challenge, or let's call it the debt piece is always going to be a challenge. Now, I think the debt piece is going to get easier, sort of a little bit. Once we see what happens in 5 days or so, or 6 days, when the Fed comes out and probably drops it 25 basis points, maybe that opens things up a little bit on the debt. I don't think it's going to make a big, huge dent on multifamily or commercial real estate. It's going to affect, if anything, residential real estate probably more, right? But will it, for the residential side, will then be like, oh, now people want to buy, so great, so prices are going to go back up again, right? So I don't know what I don't want to be Jerome Powell, because the Fed has a horrible way, I don't want to be in his position, let's put it that way, right? But I think it's going to change, right? You almost kind of have to almost guarantee it's going to change based on the cycle we're in with the interest rates, and also with the election coming up and all that kind of stuff. There's a whole bunch of different things going on, but I would say that would be a challenge. But we've been able to mitigate that challenge by underwriting different models, right? Finding out what works. We're looking at fixed debt no matter what we do, right? And so even our bridge loan debt, we've gotten 8.5% bridge loan. Even one was at 8.2% bridge loan debt, fixed rate for 3 years, interest only, right? Where we build in a bunch of reserves. And at that point, our goal is NOI, right? What can we do to value add the property, right? And bring that NOI up from where it was to where it needs to be, in that shorter time frame. So we can either sell the property faster or refinance it with better terms into a longer term debt. And another property, so for example, we have a property in Jacksonville, right, which has bridge debt on it, right, where we're asset managing it, and we're be able to increase the occupancy up to, I think we acquired it, and when it dropped down to like 70% when we acquired it, because what happens when you acquire properties, sellers don't really care about them anymore, right? So they let things slip through the cracks on purpose, probably, right, or without telling the buyers, right, about it. And you know that very well.
Or they shove things through the cracks. We've seen that too.
that too, like, oh, we're gonna get these people in the door, right, and get them leased up and counted as as not as vacancy, right? But anyway, and then so that property we're able to really push the NOI up with doing the CapEx projects we're working on. We're doing interiors, upgrading it. Now, we might not have been able to push the rents so much because the rents have softened across the country, in different areas. But we're still getting good value for the rents that we have, and it's still building our NOI up nicely. Now, on another property, we were able to get fixed rate debt, right? So I'm sorry, not fixed rate. We were able to get institutional debt at, I think it was 5.7, around that range, 5.75. And this was back in like February, right? So when the markets were going haywire with debt, right? And so for commercial real estate, we still see good terms if your property has, good occupancy, good, if it's a good, easy strategy on the play, right? And that's, I think, what we're seeing is different areas there, right? So there's a lot of different, again, this, every property that you look at, is going to be different than the last one. There's no two properties that are alike when it comes down to debt, equity. And what we haven't even talked about is, raising capital, which is a, very hard thing to do these days too, right? So, yeah.
Well, yeah. And so what you've articulated is, I think it's what a lot of us have felt across the industry. And so you have to remember, folks, that, real estate is a long-term investment. It traditionally outperforms anything publicly traded, especially, and by the way, REITs are not the same. Don't go buy a REIT. That's anything publicly traded is subject to emotional sales, right? But when you get into a project that's, at least 5 years, just don't count on money coming back in 2 or 3 years. Focus on the 5 year, 10 years better, right? Because it's really a 10-year game. But if you think about it, there's going to be a cycle, and they're about every 10 years, honestly, right? So you're going to have a cycle in real estate. And so the good thing is the cycle, with everything tightening up, meaning all the money got more expensive, investors are more on the sideline, which I'm going to come back to, so put a pin in that. There's more investors on the sideline right now because they're scared, right? You see tough press. But the funny thing is, this cycle, the fundamentals are really really good still on the properties. The only thing wrong with the pricing on the properties is the money, the debt got too expensive because interest rates went up, right? And so, yes, naturally, if you have a physical asset and you're like, well, it's actually worth this, but the cash flow is saying it's worth this based on the debt, I'm not going to sell it unless I have to right now. So that's meant a lot less deals have been done. People like Jeff and his team are able to weed through the hundreds that are hitting the market and find the ones that are truly in enough trouble to have to kind of come down to where the pricing is today. Now, what does that mean? You're probably going to pay a little more for it than you want to, but it's still down 25% from where it was 2 years ago. And so that's a good basis going in. So be patient, get into the deal, let them execute the value add. You might have debt that you hate for a little while, but debt is temporary, basis is forever. You get that low pricing today, guess what's about to happen? And Jeff knows this because he's building too. We have had an unprecedented amount of deliveries in the last 2-3 years because when COVID hit, guess what else happened? Everyone was scared about what operating properties would look like. So most of the big money went and built apartments because like, well, it takes 3 years to get through it anyway. Well, guess what? 2023 hit. All those apartments started showing up. Now now that's what's causing the downward rent pressure because we just had a bunch of supply show up. But guess what?
Rate,
but guess what? It's getting gobbled up. And so by the end of this year, you have a lot less deliveries next year. By the end of this year, that's going to not really be a thing anymore. And it's already starting to normalize in some areas. But then think about this. 2023 hit, interest rates blew up. Well, guess what? Now virtually all construction is done on short-term financing. That is the rate that blew up. So everyone who was thinking about building were like, well, gee, inflation has costs up and my cost of debt just went through the roof. I can't build this and make money on it. So starts of construction, especially on single family homes and apartments, but single family homes where you're talking, went through the floor. So folks, if you're getting into deals right now with people like Jeff, people like me, we may not see the great 8% cash on cash return in the first 2 years, but if you freaking hold on for 2, 3, 4, 5 years like you're supposed to, wait and see what happens in 2025, 2026, 2027, when we haven't built anything for 3 years. That supply and demand is going to go back the other way. And so you see what I'm saying? You have to think about the big picture. You can't look down at today when you're buying real estate. So Jeff, feel free to add anything to that, but I really want to take it over to you. We've both now mentioned that a lot of investors are on the sidelines. Add anything you want to what I just said, but I want you to come to what are you saying to those people right now to help them realize the opportunity that we're in right now, but also how to stay safe?
Yeah. I mean, I want to touch back on the absorption rate that happened currently, right, and where it's leading in the next couple of years, because that was one of the reasons why I mentioned earlier that we are very excited about our ground up development opportunities, right? So we've seen a very minimal amount of permits have been putting in, a minimal amount of construction happening because right, that's kind of weird. If you can't make the numbers work on a new construction because the construction costs are high, labor costs are high, debt's high, like how are you supposed to do it? Well, we've you got to find, like they say, right, land is not being what you say, you can't find land anymore, you can't create land anymore, right? So you got to find good pieces of it, and location is key, right? So I just came back on Tuesday from a trip down to St. Petersburg, Florida, where we just acquired 4 plots that we're going to be building over 370 different 370 units of multifamily, Class A multifamily. So if you haven't been to St. Petersburg, I take a look at it because that place is blowing up and it's amazing. I felt so safe down there. I felt it was such a cool spot. Like, it's so eclectic. It's got great restaurants and tons of development happening there right now, right? So anyway, so we closed on this land because we said, you know what, we are going to do whatever it takes to buy this land, right? Which is already entitled, which is the beauty part about it, right? So there's a couple of different things that happen when you buy land, right? You buy raw land, right? And then you work your butt off for about 12 to 15 months to entitle it, which basically says the city will allow you to build a multifamily apartment or whatever it is you're building here on this plot of land, right?
Once you're hearing there is government, you're having to work through government to get it done. So
that's right, working through. Right? That's why it takes so long. That's why it takes so long, right? The longest part about every project is the government trying to get them to move on it, right? But once you buy that land becomes like 4 times more valuable, right? That is entitled, right? And so you buy the land that's entitled, and then the next phase is you got to go through the plans and the permits, right? So you go through all the architectural plans, make sure you cross all your T's, dot your I's, you hire the right people, right? Put the right people in the bus, on the right seats, right? That know the right people that can figure out how to move this project along. And then once you get to a site where you then apply for your permits and you get that, which could be another 6 to 9 months or so, right? At that point, that land becomes even more valuable, right? Because people, big, large developers, they want to be able to go in and buy a land that's ready to be built today. They don't want to go through the whole process of the entitlement, the plans and permit side, right? So, but we want to do that, right? So we got this land entitled. We're going through the plans and permits portion right now. And we're going to break ground on this beautiful land in, hopefully, like I said, hopefully less than 12 months, where we're going to build a 16-story Class A building in downtown St. Pete. It's going to be beautiful. And then right next to it is another, joined to it, we like a mid-rise, another 150 units there, and then another plot where we can build another 70 units, or we might just sell that property, right, and put the profits right back into this one and then make it bigger and better. So again, I say that because there's you're not seeing a lot of construction coming into play now, but we know that if we can move forward on this property here, get this thing ready to go and get it leased up by, let's say, like 26, 27, we're in a prime position, like you mentioned earlier, the same timelines where having units available will be key in those markets. So the equity side, or I would say raising capital side, has been, it's hard. Like you said, there's a lot of investors, big investors on the sidelines, but I think we're seeing a shift right now, a turn, right? We're seeing, no one can predict or know when we're going to be at a bottom of a cycle, right? No one can predict that, right? But I feel like we're getting close to, if not, we're at that point, right? Or we're in that fine area, right? Where it's like the bottom is going to hit, and maybe we're going to be on our way up and so forth. But that's why we're buying real estate right now. Like we're buying real estate and we're investing in commercial real estate right now because we know you're buying a business that has real estate attached to it, right? Basically is what you're doing. So if you can operate that business, which is what our team is really, really good at, is operating businesses and structuring the asset to make sure it's profitable, right? And managing the managers, right? Make sure that everyone's doing their job correctly. If you can do that, right, then now's the time to buy real estate because it's only going to get more expensive in the future, right? Whether it's a residential home or it's a commercial property, we're seeing all of that happen. Right? So again, I think right now we're looking at a really good, but it's been harder in the last 6 months to raise capital. But we're still doing it. I mean, I think we've raised a lot of money over the last 12 months, right, for a number of our deals. And we just have, a good outlook on what's happening here as we move forward. But these private deals are so much better than what you would, like you said earlier, about investing in a REIT. Like you don't get any depreciation, you just get a couple dividends on it, right? Nothing big. And guess who's making all the money? The Blackstones, the big ones, right? So the people raising all those funds, right? So, we're trying to do the same thing as that, but on a private side where we can then provide a better return to our investors and have them be owners in that property and feel something special when they know that they're changing other people's lives, right? Not just their own. I think that's a big part of we don't talk about a lot in real estate investing, is that the residents of the communities are the important people. They're the ones that we need to make sure they're in a safe environment, right? We're putting in all the security aspects, right? Whether it's cameras or security guards, whatever it might be, gates and all kind of stuff. We're fixing up the properties to make sure that they're safe for their kids. And we're building a better community because of it, right? So we don't talk about that a lot, but that is a big, that kind of pulls at my heartstrings a lot, right? Because anything I touch, I want it to be better than where I came from, right? Whether it's I go rent a car, I'm not going to trash somebody's car. I'm going to go rent a car. I'm probably going to wash it and clean it, and make sure I clean it before I give it back to the people. Same kind of scenario, right? Whatever we touch, we want to make it better for the people living there and even the next investors that buy it, right? We're not, that's always been a big thing for me too. So I don't know. It's a lot to unpack. I'm
No,
sorry,
that's
Chad.
fantastic. And I think that's the mic drop moment of the episode. It's like, look, everybody wins in these things. This
Yeah.
is not one of those things like, you know, for me to win, you have to lose, right? It's like when investors come into a deal, we buy something together. When you're with the right operator who's doing the work and improving the community, you're creating jobs, you're making a safe, affordable place for someone to live. In a lot of cases, more affordable than what it takes to get into a new place, you know?
Sure.
And everybody wins. The global economy wins at the same time because you know you're supporting housing maintenance, and so it's fantastic. So let's take that as the mic drop moment for the day, Jeff. Thank you for all the wisdom
Love it.
and your heart on that. Let's go to a couple of Quattro questions before we end the episode. How's that sound?
Sure. Let's do it.
All right. Number one, tell me what your superpower is and how it benefits you. Could be life or business. But yeah, what is that?
Yeah, that's a great question. I would say it's my just drive and my authenticity, right? I mean, there's like what you see, Chad, is what you get. Like, you know, you and I've talked a few times offline and so forth, and then we met in person and so forth, right? At that time, I'm big on having people know that, like, you know, I am me no matter where I am and in any situation, right? Whether I'm checking into a hotel and something's not working, or I'm meeting somebody at a restaurant, or I'm going golfing, or you know I'm just going shopping for the day, or whatever it might be, right? If I can't be authentic and show people who I really am, then you know you shouldn't be working with me, right? So, but yeah, that's the biggest thing to me is I love that aspect of just being, you know, if you're authentic, you know, and you're an honest and you're a good person, like good things will happen.
So you guys heard it from his mouth. He's the same authentic shitty golfer all the time. You know?
No, I didn't say I was a good golfer, Chad, but yes, that's right. When I'm out there, I'm
He's
having
authentically
fun.
bad.
Yeah, you can't have a bad day on a golf course. That's
No,
sure.
absolutely. So let's flip the coin over. You know, tell me about
Sure.
your biggest mistake or failure or lesson learned. Could be life or business, but most importantly, what did you learn from it?
Yeah, I think you know, one of my early jobs, I managed a team of salespeople, and I was more about me than I was about them, right? And I think that was it's a life lesson I've taken to heart, you know, big time. Is that you know you really need to be you know, add value to whoever you're doing whenever you're doing it, right? Because you know that, you know, if you're just out for yourself, like people will see through that, right?
100.
And it won't benefit anybody, right? So if you're adding value and you're, you know, being authentic, I go back to you being authentic, and you really care about people and what they need over yourself, I think that's going to be a big one. So I think one of the big lessons I learned there was that from a previous job I had. Yeah.
Yeah, to append on that, folks, there's a great book on that called The Go Giver, and that's actually the first law of 5 laws that it goes through, and it is the law of value. You know, how much you do for others over and above what you get in return, and
That's
that
right.
is
Yeah.
it triggers the human response of reciprocity. So it's like you know you just, for example, the age old thing, help an old lady cross the street or carry her trash to the dumpster, and you know crazy thing is a lot of times they come back and bake you some cookies or something. It's right.
Yeah.
It's like they just want to do something for you. So
Yeah.
it's
Yeah.
that's how it works, folks.
I think also on that note too, like I try to instill that in my kids
Yeah.
without telling them about it, right? So like I do act like actions like that, like I help holding the door open for people, or you know, helping a neighbor out, picking up trash when there's something on the side of the road that shouldn't be there, or whatever it might be, right? I try to do that so that way, you know, I can, you know, it almost, you know, it bleeds into my children's lives as well too, so they see, you know, hey, dad's doing that and he didn't really have to, right? But you
Yeah.
know, he's doing it anyway, right? So I think one of those things.
I love that. So, Jeff, last question. How do we get in touch with you? How does someone from the show or from the audience say, hey, you know, I really want to talk more with Jeff and his team, see what they're doing, see how we can help each other, maybe invest? How do we reach out?
Yeah. If anybody wants to just check out our company, it's ValourusCapitalPartners.com, and it's VALORIS capitalpartners.com. That kind of gives you a little bio about all of us on our team, and any of our active deals are on our website as well too. If you want to reach out to me personal, I'm on Facebook. It's just at Jeff Ervick. I think maybe it's Jeff Ervick, Ervick. and then LinkedIn as well too. Those are the two platforms that I'm mostly on.
Fantastic. And folks, as always, if you're driving or listening on the go, this will be right in your show notes for your clicking pleasure. So thanks, Kyle, for doing that. And scroll down and you'll have it right there. So with that being said, let's conclude the episode today. Let's land the plane. Jeff, thank you for coming on the show, sharing your wisdom, your knowledge, your heart. Really appreciate you, buddy.
Hey man, I thank you, Chad, and good luck for all your future endeavors on your podcast. I mean, you're awesome at it. So this is like a natural for you.
I appreciate that. And folks, we look forward to coming back to you here in a couple of weeks with a focused series on property management, several episodes in a string. So stay tuned for that. We can't wait to be back with you. Folks, if you get any value out of the show, again, we encourage you to like it, share it, swipe it, whatever you're watching this on, just do something, right? And pay it forward and show the algorithm that you love it, and it'll show it to more people just like you. With that being said, this is the final interview series episode for a little while. We're going to be, Kyle, edit that out. If he doesn't, let me know and he's fired. Coming back in. All right, everyone, we're going to miss you for a little while. This has been another episode of the Real Estate Runway podcast. Over and out.
See you.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com and scroll down for more info. Until next time, this is the Real Estate Runway podcast.